Today we are talking about one of the most misunderstood and most audited areas of business owners. How much salary should you take from your S corporation? Because if you get this wrong, you could be setting yourself up for penalties, back taxes, and unwanted IRS attention. Hi, I'm Aradhana Aggarwal. I am a CPA, and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. If you own an S corporation, you have two ways to pay yourself: salary, also called W-2 wages, distributions, which are not subject to self-employment tax. And this is where the strategy comes in. Salary is subject to Social Security tax and Medicare tax, but distributions are not. So naturally, business owners think, let me take a very small salary and the rest as distributions. And yes, that can save taxes, but there is a catch. The IRS requires that you pay yourself a reasonable salary, not the lowest possible salary, not whatever you feel like, a reasonable one. So, what does reasonable salary actually mean? The IRS looks at what someone else would be paid to do your job. They consider factors like your role in the business, your experience and qualifications, the time you spend working, the type of services you provide, industry standards. So if you are running a full-time consulting business, generating $300,000 in profit, paying yourself $20,000 in salary is likely not reasonable. Let's look at a simple example. Let's say your S Corp makes $200,000 in net profit. Option one, you take $200,000 as salary, you pay full payroll tax on all of it. Option number two, you take $80,000 as salary, $120,000 as distributions. Now you only pay payroll taxes on $80,000. That difference can save you thousands of dollars, but only if that $80,000 is considered reasonable. So how do you determine the right number? There is no exact formula, but there are best practices. You can look at your salary data for your industry. Use websites like Glassdoor or the Bureau of Labor Statistics. Work with a CPA to run a compensation analysis. Some professionals even document a formal reasonable compensation study to support their position. Here is an important point. This is not just about compliance, it's also about defense. If the IRS audits you, they will ask, why did you choose this salary? And you need to have a solid documented answer. Now let's talk about what happens if you get it wrong. If the IRS determines your salary was too low, they can reclassify your distributions as wages, assess back payroll taxes, add penalties and interest. And this can add up quickly. A common red flag: business owners who take little to no salary but consistently take large distributions. That mismatch is one of the easiest things for the IRS to spot. Another mistake is setting your salary once and forgetting about it. Your reasonable salary should evolve as your business grows. If your income doubles, your salary likely should increase as well. Now let's talk about timing. Many business owners wait until year end to figure it out. But ideally, you should set your salary early in the year. Run regular payroll. Adjust if needed before year end. This keeps everything clean and consistent. Also remember, even if your business has a slow year or a loss, and if you are actively working in the business, you are still expected to take some level of compensation. Here is a practical way to think about it. Split your income into two buckets: payment for your work, salary; return on your business ownership, distributions. Both are valid, but they need to be balanced properly. So, what is the takeaway? An S corporation can be a powerful tax saving tool, but only if you respect the rules. The goal is not to eliminate salary. The goal here is to optimize it. When done correctly, this strategy can reduce your self employment taxes, keep you compliant, and give you confidence if the IRS ever comes knocking. If you are unsure whether your current salary is reasonable, it's worth reviewing because small adjustments today can prevent big problems later. Thanks for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.